Welcome to another episode of What's on Your Mind, a show hosted by the Institute of Trading and Portfolio Management, where we'll be talking to the Institute's senior trading mentors about what's been on their mind in the financial markets over the last week. I'm Chris Quill, and today I'm joined by Jason McDonald and Hichem Djouhri. Now, just to point out, Jason's actually calling in from Thailand, where he's on a vacation mentoring program. So he's out there with Anton and some of the other mentors, and they've been teaching a batch of students for around a week or so already. So it's great that Jason can join us from there. Now, just on that note as well, because of all the commitments that a lot of our mentors have at the moment with students and with teaching, we are going to be taking a week's break in What's on Your Mind. So there won't be an episode next week, but there will be an episode the following week. So we'll pick it up then. As always, let me remind you guys that if you want to learn more about trading and investing in general, or more about what the Institute does, then do visit our website, itpm.com. And from there, you'll find a lot of different links to various educational resources. So things like our live upcoming seminars, our online education courses, bite-sized videos, and mentoring programs that we do around the world as well. So with that being said, let's jump straight back into the show. And Jason, I think we'll start with you. I imagine you've had an interesting week both inside and outside the market. So what's been on your mind?
Yeah, hi Chris. Hi. To return to, I guess, an old friend. One thing that's been at the forefront of my mind is our old friend, the euro dollar situation. So I'm sure everyone knows we had the Bavarian state elections over the weekend. They're now out of the way. To put that into context, that was actually a pretty crushing defeat for the CSU and the SPD, which are kind of like the mainstream parties in Germany and in Bavaria. So for the CSU, is actually their worst election result since 1950. And again, in a major European country, we've seen the voters basically moving away from the centre and going towards the extremes. Now, the interesting thing was that, that was a pretty crushing defeat. And yet the euro dollar rate has actually hardly moved. So that got me thinking a little bit. That even though, to be clear, the fundamentals, I think, are certainly not great for the euro, and this is another indication of the kind of post-World War II political consensus falling away, the fact that the exchange rate has barely moved, I think highlights a risk here that there's basically, over the next few weeks, there could be a vacuum in terms of market-moving headlines for that. And so, this is a very consensual trade where a lot of people are the same way in terms of short euro, long dollar. So what I'm seeing is that potentially you could actually see a squeeze the other way, where you get a rally, maybe, 117 or higher. You get some of the weaker shorts potentially getting squeezed out. There's literally every person and their dog are kind of watching every tick of the Italian government bond market. And I think that actually, if you do see that squeeze, certainly if you get towards the 119 level, I think that would be a great opportunity to get into that trade. But as I say, the risk is that in the few weeks from now, that we're not seeing market moving headlines. It's just the same old stuff with Brexit. And of course, one of the features, Hichem, maybe you can answer this question, with the rising dollar. Generally, oil has not had an issue recently, obviously going up. What do you think might be the case here if we do get this play out where the dollar does weaken a bit, let's say? What do you think is going to happen with the oil price?
Well, I mean, the oil price right now, it's a good question, Jason. There's been a few factors that have been affecting it. We've talked about this on a few of the episodes before. So we've had the rhetoric from OPEC that has driven prices further, but also what's happening currently, especially the situation in Saudi Arabia, which I will touch upon a little bit later, has had a direct impact on oil prices, at least keeping them elevated between the $80 and $85. I think right now, as we speak, we're at about $82 a barrel on Brent. So if the situation politically escalates, and currently it's more the politics that are in the driver's seat rather than the economics, then we could see a further rise in the dollar in oil prices, despite the dollar being continuing to strengthen. That's an interesting development. There's a lot of decoupling that we're seeing happening overall. I mean, the market essentially has been taking the elevator down rather than the stairs. And this market correction that we've seen currently, and just deviating a little bit away from oil, has coincided with earnings season. So any negative surprises that we see in earnings will confirm that the market has entered into bear territory. But a solid earnings season, on the other hand, will calm equity markets to a great degree. So the market currently expects earnings growth to slow down, and coupled with any further tightening by the Fed, we may very well be headed into the next cycle. So the earnings season will be a very decisive factor, whether we are in a correction or full-scale flight from risk assets. A little bit more on that. U.S. economy is revving up just as Europe and other major economies lose steam, and that touches upon what you were saying about the euro. So this jeopardizes a rare period in which the world's largest economies have been accelerated together or in unison. So the macroeconomic situation is very different in the rest of the world, as Trump economics are creating some collateral damages across the board. There are some early evidences that trade war has had some negative impact on Chinese GDP growth and earnings, with some ripple effects around the world, some of which we're feeling here in the region. And Trump's policies are also creating a dollar shortage, which results from the lack of coordination between the Fed and the U.S. Treasury. So there's more debt issuance to finance the deficit. So this soaking up of liquidity is creating major issues for emerging markets, currencies, and their economies. Another key headwind for many developed and developing economies has been the rise of oil price. So the strong energy prices help oil-rich states in the U.S. However, energy importers around the world are clearly impacted by this development. And the same divergence of performance between the U.S. and the rest of the world seems to be valid on the earnings front as well. As you can see from the chart that we're going to share with you, U.S. earnings forecasts are still edging higher, while optimistic forecasts for Chinese earnings, for example, are being trimmed. European earnings growth has also been clearly underperforming. So the bottom line really here is that investors need to face a new reality for the time being. The U.S. economy and corporate America are outperforming most of the rest of the world. And this macro and fundamental performance divergence has translated into financial assets relative performance, with U.S. risk assets clearly outperforming. Another chart that I'd like to share with our viewers is the relative performance of U.S. stocks versus the MSCI All Country World ex-U.S. Index, which currently is at its highest level in history. So this confluence of factors has driven this move. So we've talked about trade fears, strengthening dollar, currency prices, and commodity prices as well, and U.S. earnings growth cycle currently. Another interesting thing that I want to point out is this sort of extreme performance differential between the Russell 2000, which tracks U.S. small and mid caps, and the MSCI Emerging Markets Index, and 6-month performance differential between the two recently hit a 95th percentile extreme, and you can see that on the chart as well. So there are a lot of divergences happening across different asset classes that have been developing as of late.
So one of the things you mentioned, sorry Hichem, one of the things you were mentioning there was about the yield curve kind of having an effect on sort of creating a dollar shortage essentially. And I've noticed as well, Jason, that you've also been looking at the yield curve in the US. Do you want to expand on what you've been looking at a little bit?
Yeah, I mean, obviously, apart from the effects that higher rates, generally speaking, have in terms of hitting the higher dividend-paying stocks, one thing that occurred to me was, particularly with the banks, the broker-dealers, so people like Goldman's, Morgan Stanley, E-Trade, Charles Schwab, etc. These guys, although rates have been going up, the yield curve has also been flattening. So these guys, in terms of the banks, they actually want the yield curve to be steeper. That helps what are known as their net interest margins. So a flattening yield curve is not great for the bank's earnings. And equally, in terms of the brokers, it kind of hampers their ability to profit as much from financing their clients in terms of the spread between what they effectively allow their clients to take leverage at in terms of obviously what they're lending to them at and what they're being funded at. So yeah, that would be my point, is that you actually could see that Q4 is a bit of a challenge for some of these banks and brokers because of the flattening yield curve.
Yeah, sure.
Go
on, Hichem.
Yeah, that's an interesting point you make, Jason. I want to tie it to what's happening in the region. I mean, we've talked about oil, and there's renewed U.S. sanctions on Iran. There's the collapse of Venezuela's crude production. Unexpected disruptions out of Nigeria and Libya. So all of these supply disruptions need a shock absorber, and that shock absorber to a large extent has been Saudi Arabia. And with all the news that we're seeing daily, the rhetoric coming out of Saudi is a reminder essentially that dependence on the U.S. for security also comes with dependence on Saudi for stable gas pump prices. So and with the sanctions on Iran's 2.5 million barrels per day of exports starting next month, Saudi is going to be increasing their oil output. And the reason that I'm talking about this is because the news that we've seen coming out of last week with the issue in Istanbul, the market here has taken a huge sort of correction. On the day of, we were down 4%. The following session, we were down 7%, only to close a little higher. So again, politics are definitely in the driver's seat. But what's interesting is that with Saudi being in the limelight, the market taking such a big tumble, the interesting thing to look at is, so oil prices are going up, but again, tying it to what Jason's saying, we need to look at what's happening with the earnings. So for investors, really the main focus should be on sort of the longer term fundamentals of companies. And we've been through several of these situations before, from post the financial crisis to the Arab Spring to the collapse of oil prices in 2015. And every time we hit those levels, the PE levels obviously correct significantly. So for example, in Saudi, the market tends to trade around 20 times earnings, and it becomes a compelling buy when you're at around 16, 17 times. This is just if anybody tracks the chart of the Tadawul versus and inserts the PE on there, you'll see that there's a support at those valuations. For our listeners and viewers, one needs to take a little bit of a longer term view and be able to stomach, or have a strong stomach that can digest the volatility and profit from market gyrations. But selection remains key. When we talk about selections, you need to look at sectors that have been really hammered, such as the construction sector, which is trading well below book value. Also, more regionally speaking, there's women driving. There's a Saudization program to increase employment amongst the local population. So what this does is it puts more money in the pockets of local citizens, which in turn results in improved discretionary spending. So another sector to look at would be consumers and potentially banks. So banks in the region are only partly reflecting the ROE and net interest margin expansion from higher rates. But as Jason was saying, with the yield curve, that may actually play out the other way. So it's important to really examine the valuations and what's happening with the yield curve. Another interesting play is urea prices, which have rebounded quite significantly. I mean, I don't want to dive too much into that, but what's happening in the market right now, when you have massive corrections like this, essentially all companies will take a hit. Yet some of them have very strong fundamentals, and they have the potential for, or we have visibility rather on improved earnings.
Okay, well, that certainly gives us a lot to think about from a macro perspective. Moving back to you, Jason, have you been looking at anything from more of a micro perspective?
Yeah, so if you remember a few weeks ago when we were talking to Chris Cathy, and it was the first time that on these broadcasts that we were talking about that switch away from high growth tech and into value. And on that particular discussion, Chris mentioned GE. So I thought I'd actually go back to that because that rotation is still taking place, and I think GE is still a potential play here. You think about that stock; it's down 60% in the last 2 years. The current market cap is less than its actual company revenues. So I've been looking at a potential options trade to do, which is in the June 2019 puts and calls. So basically, the way this structure would work is you would look to sell the June 2019 $10 strike put in GE, for which you'd get in, maybe 53 cents. And then you would go long as well, the June 2019 13.17 call spread, which is going long of the June 2019 $13 strike call and selling against it the June 2019 $17 strike call. You'd pay $1.12 for going long the 13 call. You'd get in around 25 cents for the 17 strike call. In total, that strategy is going to cost you about 34 cents. The stock is currently around $12.15. If you see a half decent rally in the stock, that's the kind of trade where you're going to make 10 to 11 to 1 payout ratio. So in other words, making a 10 times, 11 times your cost in terms of potential profits. That's if you get a decent rally in the stock. And if you don't, then I'm quite happy to own GE at $10. So that's the way that I would look at that. And then actually, Hichem was talking about China earlier on as well. And this is a bit of a macro-micro situation again. So I've been looking at Sotheby's. The ticker is BID on the NYSE. This is on my watch list. It's not ready to action yet, but it's definitely a potential short. Now, the reason is that effectively the art market is basically like a kind of supercharged bull market play. So, for example, in 2014 to 2016, when commodity prices were weak, when the Chinese were tightening capital controls, prices and volumes essentially plummeted in the art market. And the art market also correlates positively with global GDP growth. So a Chinese clampdown on taking money out of China also impacts premium property prices around the world, which is another feed into Sotheby's income stream. So, one might think that with stock markets earlier on this year at all-time highs, that this would be fantastic news for Sotheby's. And actually, in the first half of 2018, auctions and private sales volumes were strongly up, but actually Sotheby's pre-tax profit margins in those areas dropped. And that's in a really good, really strong auction and private sale market. Last year, at least over a fifth of their sales were generated in Hong Kong and the People's Republic. But also you've got to think about Asian clients that are dotted around the world in all the major cities, London, New York, Paris, etc. So that actually means that the Asian exposure is greater. Now, on the other side of it, we look at what's been happening with Chinese financial markets as a result of all the trade war stuff. You have a look at what's been happening with the renminbi against the dollar. So what do you think might happen if say, China puts harsher or tougher capital controls in place? So if you think as Sotheby's as essentially a turbocharged call on risk appetite, so being long of it is like having a leveraged bet on a bull market. What happens if those capital controls get worse? That is what you're long of. So that's why I've been looking at potentially shorting it. It's actually had quite a decent pullback since the summer. So it's on my watch list. It's basically a wait and see. I'm hoping that the stock will rally to get in at a good level. Of course, the other way to play it is to look at the long-term put options.
Unfortunately, I think that's all we have time for this episode. So, Jason, Hichem, thank you very much for joining me on the show and sharing your thoughts with us today. I look forward to catching up with you guys on another episode in the future as well. And just to remind you guys watching, we are going to be taking a break from the What's on Your Mind series for 1 week. That's just due to mentoring program commitments that we have around the world. A lot of our mentors are really busy teaching students around the world at the moment. So we're taking a 1 week break and then picking it up the following week. And again, I want to remind you guys watching that if you want to learn more about the sort of things that the Institute does and teaches, or learn more about trading and investing in general, then do visit our website, itpm.com. From there, you'll see a lot of different educational resources. So links to things like our live upcoming seminars, our online video education, bite-sized videos, and mentoring programs that we do around the world as well, just like the one that Jason is on right now. Jason and Hichem and all our mentors can really help elevate your trading expertise, and I'm sure the guys in Thailand right now can vouch for that. So that's all from us. I hope you enjoyed the episode, and make sure you tune in next time for another episode of What's on Your Mind.